Welcome to the Cashflow Ninja, the podcast sharing how to create and grow income streams and manage, multiply, and protect your wealth in the new economy. Are you tired of trading your time for money? Do you desire freedom today instead of retirement in 10, 20, or 30 years? I'm MC Laubscher, and this is the Cashflow Ninja.
This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me in another episode of the Cashflow Ninja podcast and spending your most valuable resource, your time, once again with me on the show. A reminder, you can check out all of our previous podcasts. There's over 650 of them between the Cashflow Ninja one and the Cashflow Investing Secrets podcast at cashflowninja.com. There's also community resources and a lot of useful tools that I guarantee will be of value to you on your journey. I've got another fantastic guest for another great show today. I'm joined by Stephen Bowles. Stephen, welcome to the show.
Thank you, MC. It's great to be here.
Yeah, great to connect and finally have you on the show. I've known you for a while, and every single conversation I have with you, I learn something new and get a different insight when it comes to wealth strategy, wealth planning, and so forth. But for our listeners and viewers out there that's not familiar with you and what you do, can you please share a little bit about your background and journey with them?
Sure. So I work for a firm called Momentum Advanced Planning, and we are a family office consulting firm. And what that really means is we were born out of a family office, and we've taken the experience that we've learned over the years in planning for that family, and we've put together a process that works really, really well to help us be able to apply that to other high net worth families, ultra high net worth families, and other family offices. So some of the experience that we have, families who are high net worth but don't need a family office can take advantage of that because we understand how to articulate that down into that space. And so that's really our background. I'm part of a team that works in that space. We work with advisors across the country. We work with specialists across the country to work with just a handful of families a year that fit into that category.
When it comes to like the net worth, let's just use that as kind of a yardstick for folks that are not familiar with family offices and how they work. What is sort of the let's call it a yardstick, right, of where they fit in? Because you have a single family office which manages the wealth of one single family, right? And then you have a different structure for family offices that manages multiple families. And then some of the other parts of it, where does it kind of fit in? What's sort of the yardstick for families and the type of planning that they have access to?
Sure. And on the one end of the spectrum, like you mentioned, you have the single family office, and that's really the ultra affluent families that really need to run their family like a business. And that's that structure that's on this side. So that's typically in that billion plus range where that starts to make sense. And then families that fall slightly under that can really benefit from the coordinated resources will be in more of the multifamily space, multifamily office space. And really the key piece, and I think what you're asking me is, hey, where does it make sense for us? Where can we help clients? And that you use the term yardstick. I like that. Is really when somebody's net worth starts to get into that 20 million plus range, that tends to be where we can help them with their coordinated planning. And I leave it at 20 million because we're not talking about investable assets, and that's one of those numbers that a lot of advisors that we work with are often thinking about. But we're really saying, hey, when you have business, real estate, and assets, retirement assets, et cetera, that are starting to get up over that, you're starting to be faced with some of the issues that we can help. And you may be, not benefiting from working with the specific specialists that you're working with now. Maybe we can take that, elevate it, coordinate it across all the specialists, and add in another layer of planning that you're maybe not taking advantage of today.
Gotcha. Now, what is the momentum advanced planning process involved? So what is the process that you take
Yeah,
families through?
sure. And one of the things that we've discovered over the last decade of working with other families is as process is key. Um, Nobody's looking to do a lot of busy work, including clients, especially clients. So they want to know that, hey, if I go through this process, we're going to get to a result that's going to work. So that really starts with discovery. Every client's different, and what families have done to date is different. So we really need to start with understanding exactly what they have done to date. And that includes taking a look at all of their documents across their estate, all their documents across their different entities. Even if it's super basic, that's okay. We want to take a look at that, read it. We dig into it. We have in-house counsel. We have other specialists outside that we can bring in. And that's that very first step is discovery. And if a client engages in discovery, then we will do that work to review it, dig into it, and then bring you right to the second step, which is review. And that's really where we need to go back to the client and make sure that we can articulate to them exactly what they have today and how everything works together. And the key piece with this MC is that what you find out a lot of times is that people start to put different pieces of their puzzle in place over a period of time. Well, over a period of time, you remember certain amount of things about your pieces of puzzle. And we just need to take a step back and say, hey, here's what the puzzle looks like. And you're saying that you want to get to X, Y, and Z, and we need to make sure that we can go from where we are today to there, but we need to know where we are today. And that's that second key critical step, which is review. And then from that point, it's about aligning the current state with those goals that we're working with the advisor and the family to really define. And that's the design stage. So we need to take the client, we need to educate them on all their options that are available. And it's our job to make sure that we can articulate that to them. And as they start to understand that and pick their path and we build their plan out, then we're going to get to the next step, which is implementation. And at that point, we're implementing, we're at the center of this. Think of us as kind of like the general contractor. We might bring a specialist in to execute on one piece of that puzzle, whatever it is, whether it's an ESOP or whether we're leveraging private bank financing like we're going to talk about today, or if we're bringing in a new trust and estates attorney, we're going to be at the center of that to help with implementing it. And then the most important stage from then on is servicing and evolving with the family, because just like their plan changed over the last 5 years, it's going to change over the next 5 years. Their goals are going to change. The tax structures and the rules are going to change, and we need to make sure that we're talking with them and we're evolving with them.
So you guys bring it all together as the general contractor after architecting this plan. And there's a lot of families that do run into massive liquidity events, right? Unexpectedly, somebody starts a business, maybe it's a new technology, and then all of a sudden there's an enormous windfall, and it's not like you could go to just any financial planner or any wealth management advisor at that stage to say, hey, I started this company and sold it for $50-60 million. What do I do? Because it's a different level of planning, which is many things involved in it, right?
It really is. And the thing to think about with exactly what you're saying, MC, is the thing that allowed them to create their wealth is not tax planning and wealth succession planning. It is building their business, building a real estate portfolio, and doing those things. So there's no reason why they should expect to be an expert at tax code and law, et cetera, and up to date on what's going on out in the planning space. And so, just like in their businesses, they are going to leverage different experts to help them with building their business. Even though they're at the center of it, they're in this, they're going to need somebody who's at the center of it, being able to leverage experts to help them.
So powerful, that little piece of nugget right there, because it's two completely different skill sets of making money in a business and then protecting it, making sure that it's positioned efficient and structured and all of these different things, and keeping it and then growing it. So there's a lot of entrepreneurs and real estate investors that might be listening to this going, know that they're phenomenal at making money. The keeping part of it and the protecting it and then the multiplying part of it over time and over generations is a completely different skill set. And just wanted to add to something that one of the things that I've learned since the first couple of times that we spent time together. Actually, we came in and we had this discussion, and it was where the majority of the public really, let's just say, I would say the average person or family, let's just even say they save 10% of the money that they're making, the income, right? They're just solely focused on trying to protect maybe and grow that 10%, right? Where when it comes to these families, one of the key takeaways that we can learn is they're focused on 100% of this, of their wealth all the time, because they know inefficiencies that can be solved through proper planning, proper structure, and having it all aligned in one powerful strategy. There's no real return in the marketplace on a small piece of their wealth that could ever replace the return that they would get to, let's just say, reduce their taxes permanently by 20%, over the course of 5, 10, 15, 20 years, and over the course of a couple generations, right?
It's true. One of the things that we often see is the biggest challenge to wealth perpetuation is you have division and you have erosion. So division among heirs. So if you do no planning, you're going to pay taxes.
We are living through unprecedented times, and many experts say that in the coming months and years, we're about to see some of the best real estate opportunities of our lifetime. Who's going to benefit the most from these opportunities? Those with access to capital, which is where the Real Estate Accelerator comes in. Brought to you by Good Egg Investments, the Real Estate Accelerator is an online course and mastermind that will give you everything you need to raise private capital for real estate syndications. Through building a killer brand that attracts the right investors, you'll be able to take advantage of the upcoming opportunities and scale your business. To learn more, check out cashflowninja.com/goodegg.
At the wealth amounts that we're talking about, you're going to pay significant estate tax, and then it's going to go and get divided out amongst the heirs. Well, how many generations is that going to last? And that's not really creating a legacy. So when you're doing good planning, you want to try to plan around both of those aspects. You want to really, if you're really trying to create that as part of your legacy, then you want to attack both of those items, both the erosion piece of taxes and also just really making sure you protect against even division down the way. And there's different ways to do that.
Yep. A great case study, by the way, is the Rockefellers and the Vanderbilts, where the Rockefellers kept the money together all in their single family office, and they still do. And with every generation, the wealth is just multiplying. And with compare that to the Vanderbilts, which, to your point, they divided it up amongst the heirs. They had some of the biggest, do we call them compounds these days? Compounds, houses, beach houses, cars in all of the major cities across the world, even at a university named after them. And at one of the last, I believe one of the last family reunions, there wasn't even a lot of millionaires amongst them. I think Anderson Cooper was one of the few millionaires, and his mother Gloria that's still part of that family line.
Yeah, it's a great example on dynastic planning, and we use that term really deliberately because there is specific dynastic planning processes that are laid out in that family. And the key piece too, I think if you were to really dig into those case studies, is that there's a big difference in asset protection in those two families. When you can really do good dynastic planning, you're not just helping with erosion and division, but you're also going to help with asset protection, and that really keeps it in the family, if you will. So.
Yep. Now, one of the strategies that I'm very excited to dive in and discuss and share with all of our listeners and our viewers out there is a strategy of premium financing. And you alluded to a little bit earlier. Now, premium financing can be a very, very, very powerful tool, as our listeners and viewers will learn in the course of our discussion today. How would you describe premium financing? How does it work? Why would some people do it? And maybe if you want to jump into the pros and the cons of that too.
Sure. Yeah. Premium financing at its core is leveraging other capital to purchase life insurance in a trust outside of your estate in a way that is asset protected, and using the least amount of your gifting and exemption. So it's an efficient way to purchase life insurance outside of the estate. And that's the basic piece of it. There's different ways to look at premium financing from a private financing perspective and split dollar, et cetera, or commercial financing, which is really what we're going to highlight today. And the real reason why this even came about is this is a strategy not for somebody who can't afford life insurance. So a lot of times we think of financing as, hey, I'm going to buy something I don't have the money for right now. And that's sort of the retail view of financing in general, just really being broad there. And that's not really the way that you want to think about that term here. The term here is saying, while I can afford it, and that's great, it's not the most efficient way for me to transfer my wealth, because I have restrictions. When you start to get into these layers of wealth, you start to actually be concerned about things like annual gift exemptions, lifetime exclusions, et cetera, that limit the amount of wealth that you can transfer without gifting and estate taxes. And that's really where premium finance comes into play. And so we kind of laid the foundation that we take a look at what the family, where the family is today, where they're heading into the future. We're going to talk about a specific strategy today. This is never the lead. It should never really be the thing where you sit there and say, hey, I heard about premium financing, let me go and get that done. You want to make sure that the structure and the foundation is created correctly, and then make sure it's a good fit for the family. And so we're going to talk a little bit about the profiles, et cetera, but that's really the history of it. Or I'll give you a little bit more history, actually. It really came from back in the 80s when those lifetime exemptions and gifting limitations were much more strict than they are, much more limited than they are today. We're sort of at a historic, not sort of, we are at a historically high lifetime exemption right now. And families couldn't transfer enough wealth outside of their estate and onto other generations to protect against the erosion that we were talking about with taxes. And so one of the things that people would do even back then is they'd say, okay, well, let me transfer assets or cash out of the estate and buy life insurance, because now I can buy, maybe I can transfer $500,000 out, purchase insurance, and then at some point there's going to be a liquidity event and all of that benefits outside of my estate. And that's a great way to do some basic planning. The problem is they couldn't buy enough life insurance with the amount of money that they could move without having gift implications. And when you start to have those gift implications, it really waters down the value that was occurring in that particular scenario. So what they started to look at is, okay, well, if you're wealthy, you have attorneys, you have accountants, and you have people that are trying to be creative and figure out what are other things I can do besides the gifting, selling, et cetera, that I know about today. And that's when they started to take a look at, well, the fact that a trust, an irrevocable trust, can purchase life insurance on a grantor, and they can own the life insurance, and that's completely outside of the estate. Now, what they need to be able to do in order to purchase and own it is that they need to be able to underwrite the loan, and they need to somehow service interest. And so that's really where premium finance came from. It's like, hey, so if I can help underwrite the loan, and my trust can purchase a policy on my life, and I can use my gifting to pay interest payments, that's way more efficient than transferring money or transferring premiums outside of my estate. And that's really the genesis of premium finance that brings us to where we are today.
It's fascinating. The first time I saw this, I was just blown away. And for listeners and viewers in there, I've shared on the show before strategies that we implement with high cash value life insurance and how powerful the living benefits are of high cash value life insurance. And in those pieces of content, One of them on my one show, Cashflow Investing Secrets, I shared how life insurance and real estate are very, very similar. And one of the things that I highlighted is that you would actually get financing from financial institutions for real estate, but you would also be able to get financing in certain instances on life insurance, which is fascinating. And this is one way where as Stephen just shared that you will be able to finance the life insurance policy for specific reasons. You shouldn't lead with that. There's certain instances in which it would make sense for someone to do that. So just a little basic understanding of the structure. So with high cash value life insurance, I'll just share what I share, and then maybe you can add how premium financing would work. You would fund the premiums, you would build up cash value in the premiums, you would be able to borrow against it through a policy loans and repay it back. And then obviously the money grows tax-free in the policy. There's some guaranteed growth. There's some dividends with a lot of mutual insurance carriers that we spoke about. And then the death benefit is then transferred tax-free to the estate or the beneficiaries. And then also the policy loans that you access would be, the liquidity that you get from that would be tax-free. And that's how a lot of real estate investors and business owners would use it, sort of as, the quote-unquote becoming your own bank sort of application. This is a little bit different. What can you share just from a premium financing 101 standpoint, how this would look like as far as how it would be structured, funded, and so forth?
Sure. Well, one thing I would say is very, very similar is you want to use cash value life insurance. Yep. And as you mentioned, banks will lend very specifically to this structure, and they like using cash value life insurance as collateral. It's a tier one asset for them. So that part is very similar. One of the things that I would say is a little bit different is we are putting this, we are recommending that for the purposes of estate planning, wealth transfer planning, that a lot of times this is an irrevocable trust. And so with an irrevocable trust comes more restrictions to access. But really the purpose of it is different than what we're saying too. It's less of that infinite banking. It's more like, hey, we're building our wealth. We've built wealth, and now we need to try to transfer and protect it. And so those restrictions are less of an issue. And now one of the other things I'll point out is why we also want to have that high cash value type of policy is not just because that cash value can be posted as collateral for this loan to get attractive loan rates, but also at the point where that cash value is grown, we can actually exit the loan from the cash value of that policy. And now you have a fully paid up life insurance policy sitting in an irrevocable trust that's outside of your estate. And if we go back to like the two things that work heavily against wealth perpetuation, that is the erosion and division part, we've really planned against that at that point by having this sit out there outside of the estate. And obviously we also know that if we put it into those types of trusts, then we can kind of limit that and help ensure that they exist for beyond the next generation.
Yeah. And then, so you would fund the premiums, it builds up cash value. The premiums are borrowed, so there's interest paid every year on those premiums that you borrowed from the financial institution. And then at some stage, you take a policy loan to repay the borrowed funds. And now the loan's been repaid back and the policy has been paid up in full, right? Correct.
Yeah. And then that's sitting outside of your state. Now, one thing I want to point out that in the interim, there's one other consideration in there, and that is going to be collateral in general. So I mentioned that the banks really like the cash value aspect of the policy. However, the cash value in the policy is not going to cover all of the collateral need for the loan. So I'm going to just use round numbers and say, hey, we're borrowing $1 million a year to fund a 10 pay, which is very familiar to you and IMC, but that just means there's 10 premiums of $1 million.
There is a massive demand for affordable housing across the United States that far outpaces the current supply. More and more people will be renting in droves, and it's putting the squeeze on an already tight rental market. This provides a unique opportunity in a recession-resistant and also the highest yielding investment niche in real estate right now, mobile home parks. Four Peaks Capital Partners has been successfully investing in this proven recession-resistant sector for years, providing investors with predictable passive income and capital appreciation. Four Peaks Capital Partners offer private real estate investments for accredited investors to passively invest in this real estate niche. To learn more how to protect your investment portfolio and at the same time generate predictable income passively, visit privateincomeinvesting.com. That's privateincomeinvesting.com.
So if we're borrowing that, and again, I just want to use round numbers, borrowing $1 million a year, there might be $700,000 of cash value in that policy in that very first year. Well, that's great. You got cash value that you can post as collateral, but that doesn't cover the whole collateral requirement. But the grantor is able to post the collateral for that gap with the lender. So it's just a consideration that they are going to be looking at, okay, I'm going to fund interest payments through gifts or loans to the trust, and I also need to be able to post collateral during those initial years to continue to have that loan, and that's going to be out of outside assets that aren't in that trust necessarily.
Gotcha. Now, who is this for, and what are some of the folks that this would make sense for, and the profiles of folks listening that might make sense for?
Sure. And who is this for? Really, it could be anybody that we would call high net worth, and that means a lot to a lot of different people. But high net worth is when you're building up your net worth through a lot of the strategies that you talk about, MC, and you're starting to get up there into that area where you have a current or future estate tax issue based on the trajectory of your growth. We should probably start thinking about that. So if I were to really overgeneralize, I'd say 15 million plus in net worth. There's always exceptions, right? If you're on the younger side and you're really building, you might want to talk about it while you're still below 15 million. But high income earners, net worth of 15 million plus. A really good profile is business owners, real estate investors, and anybody else who is just interested in trying to efficiently transfer their wealth. It can be a great fit for.
Awesome. Maybe some comments on, and maybe a slight more technical detail on how the rates work, the interest rate, because so you're borrowing money from a financial institution or a private bank to fund the premiums on this life insurance policy. What type of interest rates are available, and how does that work?
Yeah, let's definitely talk about that. So there are a few different we'll just call them levers and that play into interest rates and how that works. So most of the top tier private banks really like to borrow against that. And they have entire departments that specifically underwrite this type of strategy. So they're very familiar with it. They're very familiar with how to underwrite the collateral and the cash value. And they also offer the best rates. Well, to have access to them, you have to hit that net worth criteria that we were talking about earlier, and they also are only going to lend to a certain premium size. So there's break points on the interest rates at certain premium points, which is typically $1 million premium for at least 7 years. So where they know they're underwriting for about $7 million, and that gives you the best rates. It doesn't mean that has to be the only place where this makes sense, but that's a break point, and they're typically going to make offers that are based on 1 month LIBOR. And it could range anywhere based on their balance sheet, relationship with the bank, or is there no relationship with the bank? It can vary anywhere between, we've seen under 100 basis points spread over 1 month LIBOR up to, a non-relationship type of loan that might be more in that 200 basis points over 1 month LIBOR. And we're speaking in late September, and 1 month LIBOR is historically low as well. Yep. So it's about, at probably 18 basis points today. So that's extremely inexpensive money. But there's other things that you can take a look at besides a floating rate that come into play. And one of those things is taking a look at swapping the rate. If somebody wants more of a fixed type of option, and swaps can be purchased, they're purchased with collateral to lock in that rate. We recently did one for 9 years, and they swapped and locked it in at 2.6. Which on one hand you're like, oh well, well the floating rate's lower. It is, but he's got it for over 9 years. Yep. So there's some very interesting ways to structure the lending part. But typically you have those breakpoints, and typically they're going to be floating rates, but there are fixed rate options out there in the form of swaps, caps, collars, etc., that may be attractive. Typically, they're a little more attractive in a different interest rate environment than what we're in today. The forward curve looks like we're going to be a pretty inexpensive money for quite a while. But the flip side to that is that means that swaps are priced pretty inexpensively as well.
Yeah, when it comes to efficiency, and the other thing that I learned too from these high net worth investors, business owners, families, is they really, really know their cost of capital. So this is for a lot of them when they're looking at what rate they can finance this. I mean, it really, really is a no-brainer in a lot of situations. And when you're looking to bring this on, especially in the environment today. Let's look at a case study. Is there a specific case study, an application that you can walk us through to give us an example of what the process would look like and how this strategy was able to provide the solution for the specific family that you're going to use as an example?
Mm-hmm. Yeah, we definitely can do that, MC. Can we pause? There's one more thing I wanted to add in on the financing part. So if I can touch on it now.
Go ahead.
The other reason why a lot of families will do this type of strategy, we talk about the cost of funds, which is important, but there's an arbitrage between the cost of the funds and what the policy is earning. So we do a lot of this work. You can finance index universal life policies, whole life policies. Those are the two categories that can be financed, and we tend towards preferring the whole life category for a lot of the reasons that you like. It's just when we're looking at the different levers that can change on this type of strategy, whole life's kind of boring. It's very steady, and it's a little bit more. I'm not going to say it is predictable, but it's a little bit more predictable in what the potential outcomes might look like. So we do tend to like that. And if we look at that historically and say, where have dividends been over the last 30 years and compare that with the cost of money over the last 30 years, there's a nice arbitrage there. There's a solid 2.5, 300 basis point arbitrage over a period of time. Now, that doesn't necessarily predict the future, but that does tell us that there's a nice opportunity for the policy to continue to grow faster than the cost of the funds. And that's another reason why people do like to take advantage of leveraging other people's capital to purchase this type of policy outside of their state.
Absolutely. And yeah, I love the whole life. It just does what it's supposed to do. Right. So, and to your point, arbitrage can be very, very, very powerful. Now, is there a case study that you can review of a specific situation where this strategy helped solve a problem and create an outcome for a family?
Absolutely. Yeah. We did a case last year where, a client was brought to us. Most of our clients come to us through advisors like yourself that have those relationships. And we're kind of the specialist back there to help with those clients that start to hit into those net worth thresholds. And so this advisor brought the client to us and said, hey, I have this client. He's 50. He's a real estate professional. He's investing in properties all over the country. his net worth just jumped like 7 million in a year, and he's knocking on 30 million, and he's only 50 years old. So he's rocking and rolling. He's making extremely good income, of course, investing a lot of that back into the business. But can you help him? And we said, of course, like, let's introduce ourselves. And we started our process with him. So at 50 years old, married with 2 kids, and his net worth, it's one of those things where you work a long time to be an overnight success, right? You don't just all of a sudden jump your net worth 7 million in a year. You've been working hard for many years.
CAMAPLAN is one of the leaders for personalized tax-deferred and tax-free IRA planning. CAMAPLAN's team can assist you to take control of your retirement funds and financial future through self-directed investing. They offer support to clients throughout the entire process, from opening your first account to making your first purchase to self-managing your assets. CAMAPLAN works with a growing network of investment providers in all asset categories and offer free investor education through classes, events, and webinars with over 15 years of leadership and self-directed retirement investing. CAMAPLAN will help you unlock a convenient and safe way to manage your retirement investments and discover financial freedom beyond traditional investments, beyond Wall Street, and go from forever taxed to never taxed. Start to take control over your retirement funds and financial future today by visiting cashflowninja.com/CAMAPLAN.
And in the process, though, there really was not much planning in place. There was basic planning, we would say, wills, etc., like that. So we went through, we requested all his documents, took a look at everything he had, and we walked through some of his options for starting to prepare for the future of his estate tax liability. And we walked through some of the many options. We talked to him about doing sales and gifting and getting discounts and creating minority interests, et cetera, et cetera. And he said, hey, that's great, but I'm rocking and rolling. I'm not trying to move this stuff yet out of my estate. I want it on my balance sheet. I want to continue to leverage it to grow. And one of the options that we showed him was premium finance life insurance. And of course, he liked the idea of leverage. He uses it in his daily life. And so as we walked him through how he could purchase, we did about his future estate tax liability was easily 15 plus. So we walked him through how he could purchase life insurance through just simply paying premiums and gifting those out. That wasn't very interesting. It's not super efficient. It's more efficient than just transferring cash from a wealth transfer perspective. But when we showed him how we could take him out to the private banks, which his profile is very attractive to, and we could leverage their money to purchase this policy on his life and what that would mean for his family, he was very interested in that. So we did that. We walked him through only options. We work with about a dozen banks, and most of them do not require personal guarantees. And for a real estate profile like this, we're not even going to bother shopping it to a partner that has a personal guarantee. So we took him to a lender that not only didn't have a personal guarantee, but could also collateralize not just the cash value of the policy, but also for the gap collateral, a letter of credit, which was very attractive. Let's try to keep as much capital as possible flowing back into the business. Yep. And that's what that was the route that we went for him. And so he was able to purchase a large policy through an ILET that has spousal access options in it, that also kind of helped with a concern that he had that said, hey, I'm still really young. If something were to happen sooner than later down the road, then what happens with the family, with my wife from a sort of an annual cash flow perspective. And so we wanted to make sure that we worked with his attorney to make sure that was built into the trust as well.
You mentioned ILET, just for folks that are not familiar with that term.
Yeah, you're right. Yeah, I kind of forget because I'm talking to you. ILET is commonplace language for us, but it's a irrevocable life insurance trust, which is So as the name kind of suggests, it's set up to own life insurance on a grantor, to be irrevocable, which makes it not part of your estate. And then spousal lifetime access provisions in there can allow the spouse to have access to certain parts of the value of that trust if they need it during their lifetime. And if they don't, then it continues on to the next generation, again, outside of the estate.
Gotcha. Great, just a great way to protect it. So, in summary, the problem. What was the main problem that was solved here, and then the solution and the end result?
Mm-hmm. Yeah, the main problem that he had was, if something happens to me, I've got all of these tangible assets that will need to be fire sold in order to cover an estate tax issue, and that was a concern, and that was his current issue. And future issue is he's on this growth trajectory where not only does he have those types of assets today, but he will have many, many more in the future, because as he's continues his success. So that was a critical piece of the problem that he needed to solve in order for his family to feel secure.
Yeah, absolutely. And this might be a situation where a lot of folks, and I know with real estate people especially, which is a very big part of our audience, this becomes a big challenge when they are no longer here. At some stage, folks, we're going to leave the spinning bowl of dirt that we're all on. At some stage, it's good to plan for the inevitable. And when I see a lot of real estate investors specifically, they have a certain skill set and knowledge base that allows them to find properties and build real estate portfolios and so forth. But then when they are no longer here, as you mentioned, now number one, there's a tax issue, right? And there's assets that might not necessarily, how can I say, the surviving spouse might not have the knowledge or the skill set to take that over and manage the business, or take over the real estate portfolio and manage that. So how do you bring this all together? How do you plan for the inevitable if something's going to happen, so that things are set up now properly for when you're no longer here, so that there isn't a massive tax issue, number one, and then number two, there's a plan for your business or for your investment portfolio when you're no longer here, right?
Mm-hmm. Yeah, that's really a key point there. If you have let's just call it a bucket of liquidity at that point, where the family is trying to figure out, and the advisors around them trying to figure out what to do during this period of time, it really does add a lot of options to the table if that liquidity is there, and you don't have to sit there and say, well, I've got to figure out how to run this business because if I don't, then we're not going to be able to pay our taxes, et cetera, or maintain our lifestyle. They don't have to figure that out. They don't have to figure out how to sell it all off. And that tends to be a big concern. I mean, our clients, to your point, they have a certain skill set to build out a portfolio to that degree, and not everybody does. And they also know that if they were to turn around and try to liquidate it all very, very quickly, you can't do that at the values that you would prefer to do based on what you've built over your lifetime.
Yeah, and at that stage, it solves that problem of no liquidity. Now you got to fire sale stuff just because there wasn't proper planning taking. So you summarized that really, really well, and that's essentially what this does. So you can set up let's just say a standard high cash value life insurance to use as your own bank in the meantime, and a vehicle like this is something that can then be set up and structured according to proper estate planning to then take care of another liquidity event for the family. So changing gears a little bit, I love the dynastic planning term that you used, and legacy and so forth, and we talk about that a lot. And actually, one of the things that I learned, and through conversations with yourself and other advisors in family offices, and have seen these wealthy families do, is when the estate is transferred over or passed on to the next generation, there's a knowledge transfer too, and it comes down to a family constitution. It comes down to family principles and values, and I always share that you don't have to be the Rockefellers to write a family constitution, right? You just need some time and spend time together and have deep conversations with everyone in your family. But it also leads to what principles and values folks want to leave as a legacy for their children and their grandchildren and so forth. And it helped me came up with the following question that I usually ask guests on the show, because a core message in the show is to leave families, communities, and the world better than we found it by passing down a mindset, values, and principles to future generations, not just money. So if you cannot pass on any money to future generations and we're only allowed to pass on 3 principles to them to build wealth and achieve happiness and success, what would they be?
Oh, so you're asking me personally what those 3 principles would be?
Yeah.
Oh, yeah. Those are great. That's a great question. I was going to comment on one thing that you were just mentioning too, and that is the fact that you're right that the term legacy means different things to different families, and sometimes we as professionals try to define that for them, and you're right. That's a big mistake. You need legacy isn't just money, or isn't just the capital or what they've built over their period of lifetime. It really does come down often with a lot of our clients to values, and sometimes it's tied to tangible assets that are sentimental, and that's an important part to kind of bake into these early conversations. And I'm going to get to answering your question in a second, but I want to just go back and say, one of the things that we say is that we're at the center of where all planning converges. So yes, tax planning, asset protection, wealth succession, et cetera. But when it comes to philanthropy and family governance and those aspects, those are equally important in the overall intersection of their planning. And so, I know we focused on a strategy today, but I don't want to pigeonhole in that strategy, because we really do try to take a look at all those aspects with the families that we work with.
Yep.
Can you rephrase that question back to me? I know
Which
so
one?
I can remember exactly how you want me
Oh, just 3 principles and values. If you cannot pass on any money to future generations, and you're only allowed to pass on 3 principles and values to them to help them build wealth and achieve happiness and success. I kind of leave it wide open because there's so many different folks from different industries.
Sure. And I think one of those aspects is you should have gratitude for the opportunities that you're able to take advantage of. And then that gratitude should lead to being generous. And generosity often leads itself to a lot of growth. So those would be 2 things. Having gratitude and generosity, I think, are 2 very critical aspects to what we pass on in my household, but also what we try to take a look at with our families, and can be really, really critical. And then leveraging debt the right way. So we talked about debt today we talked about debt in a specific aspect today. A lot of our clients know very much about how to use it correctly, but if you're not passing on any other legacy besides helping people understand the right ways to use it, and to let it be a tailwind that's pushing you versus the other ways that can very easily be a headwind against you, and that would be the third aspect I think is very important to pass on. So it'd be gratitude, generosity, and understanding the power of debt and how it can be a really good tool or it could be a hindrance.
Yep. Those are very powerful. You want to be on the right side of the compound interest equation for sure, because it could either be against you or for you, right? And very well put, kind of a headwind or a tailwind. Stephen, this has been phenomenal, and thank you so much for coming on and sharing all of this very, very powerful information. Where can folks learn more about you? Where can they follow you? Where can they reach out? And how can they get in touch with you if they want to learn more about this or even have a conversation?
Sure. Yeah. So I can be reached directly at my email address, which is Bowles, BOWLES, at momentumap.com, and the AP stands for Advanced Planning. We also have an email address is planning@momentumap.com. That's a little easier to remember. So, certainly please feel free to reach out to either one. I'd love to hear from people directly anytime. That's the most fun part, is really talking through patterns and fact patterns together with advisors, with direct end user clients that are looking for some help.
Awesome. Well, really appreciate you coming on. Thank you so much for sharing your journey and your knowledge and providing so much value for all of my listeners and viewers. If you're watching this on whatever platform you're watching, give us a like or a thumbs up, or leave us a comment to let us know if you enjoyed the episode. And as always, you can check out all of the previous episodes. There's over 650 of them, with amazing guests such as Steven, Cashflow Ninjas on the Cashflow Ninja Show at cashflowninja.com. That's cashflowninja.com. There's a ton of community resources as well as tools there available for everyone that will provide value for you on your journey. Until next time, my friends, live infinitely.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness,